How to use stop loss and take profit, a simple Tradeview guide. As we covered in our video on CFDs, having a great entry point is just as important as knowing your products. However, protecting your profits or cutting your losses can be just as important as having a great entry point. Knowing when to take profit or cut your losses on a position is a key element when it comes to trading. When a trader opens a position, they have the option to place a stop loss or a take profit order along with it. A stop loss is an order that specifies that a stock be bought or sold if it reaches a specified price. The specified price is known as the stop price. Once the stop price is met, the stop order becomes a market order and is executed at the next available opportunity. This type of order is best used when traders are looking to manage their risk to a high degree. They can also allow the trader to have peace of mind when they need to step away from their screen. A take profit order is a type of limit order that specifies the exact price at which to close out an open position for a profit. If the price of the security does not reach the limit price, the take profit order does not get filled. Take profit orders are best utilized when short-term traders are looking to manage their risk. This is because they allow a trader to get out once their planned profit target has been hit while not risking a possible future decrease in the price. Let's take a look at examples of each of these. Starting with a stop loss order. When opening the trade, the trader has the option to place the stop loss order. Let's say a trader pays $100 for 100 shares of ABC. They then place a stop loss order at $95 as per their risk parameters. Over the following 2 weeks, the stock will go below $95. The stop order of the trader is filled and the position is sold for $95. In this case, the trader has been able to avoid a larger loss on the position as stock ABC continued to go down to $90 over the following weeks. The trader also has the option of placing a take profit order when opening a position. For example, a trader buys 100 shares of XYZ for $100 expecting the price to rise by $10. They then place a take profit order at $110 as per their risk parameters. Over the next few days, the price rises above 110. The take profit order now becomes a market order and can be filled at 110 or above. This has allowed the trader to take their profits as determined by their trading plan without having to constantly watch the position. Having these risk mitigating orders set up can help remove the emotion from the trade while protecting profits and cutting losses quickly. Due to the many uncertain factors of the market, no matter if you're an experienced trader or novice, you cannot completely avoid the possibility of loss. Therefore, every trader should learn how to minimize losses and crystallize gains. Setting up a stop loss and take profit orders is one of the best ways of protecting yourself. For further information on trading, check out our next simple Tradeview guide video. Don't forget to subscribe to our YouTube channel, Tradeview Markets.